first, I'll start with this headline because there are so many charts out there describing, showing, demonstrating what is going on with this topsy-turvy world we find ourselves in once again. The last time we were in similar circumstances was, of course, 2008, 2009. The unnatural speed of the moves in bond and FX markets, foreign exchange markets, into decade-plus highs is staggering. A wholesale repricing of all things at breakneck speed. The soft landing is pretty much off the table. Here you see the 2-year, the 10-year US Treasuries, and then you see the Japanese yen and the US dollar along the bottom there in the charts. And what you see are quite extraordinary moves looking back decades.
Right, so this is the global financial crisis of 2008, part 2. As you recall, back then we were saying, hey, you know what, there needs to be genuine reform in these financial markets. They need to get rid of all the highly toxic speculative derivatives, concatenation of debt, Ponzi scheme-onomics, but instead they simply gave central banks and banks on Wall Street a bigger credit card to do the exact same thing, but 20, 30 times bigger. And I said at the time, within 10, 12 years, we'd have another exact same event, except it would be bigger. Okay, that's exactly what's happened. Exactly predictable. Now we have the global financial crisis part 2. So now it's just gotten 20, 30 times bigger. And this is only going to cause so much hardship and problems all around the world, in particular in America, as the US dollar reserve goes bye-bye.
Of course, the bond markets are down like 25% in the first half of the year, which is, of course, horrible, one of the worst in decades. But I'm going to look at the 10-year Treasury because, of course, that is basically upon which the entire global financial system is based on this number alone. So just to see how extraordinary the situation is at the moment. And what we see is an update on the U.S. 10-year Treasury, y-axis and log scale, by the way. The 40-year trend is becoming quite volatile. So as you see here, Max, this is the 40-year trend. This is, by the way, when Max Keiser first started working on Wall Street, way up when the 10-year was trading at a much higher rate, closer to 20%. And here you have, the ever declining interest rates, which enabled the expansion of this debt, the rolling over of the debt at ever lower rates for the past 40 years. Well, as you can see, something has happened, something is broke. The risk that is now in the system is being repriced very rapidly across all markets, including crypto and Bitcoin.
You need penalties and you need a deterrent to commit fraud. If over the past 20, 30, 40 years, every time a major bank like Jamie Dimon, JP Morgan, Goldman Sachs, and all the banks around the world committed massive fraud, they got bailed out. And the way that they paid for those bailouts was by lowering rates artificially and by extending maturity of the bonds. That's called a Ponzi scheme. Now, finally, in 2022, the world has called time and said, you know what, this Ponzi scheme-onomics has got to go. And the pain and suffering as a result of allowing this thing to grow for decades, really going back to Alan Greenspan in the 1980s, it is going to be absolutely horrific.
Here is a tweet from the Kobieski letter. Current situation, S&P 500 in free fall like it's 2001. Treasury yield soaring like the S&P is at 6,000 when it was under 4,000. Gold down like inflation is gone. Gas prices above $5 like inflation is 15%. US dollar at a decade high like we're in deflation. Literally nothing is adding up. Again, this is like the event horizon. Once you go over the event horizon into the black hole of debt and the deglobalization and demonetization of the US Treasury reserves is not a pretty sight. It's a chaotic sight, and everything will be in a whirlwind of repricing and then mispricing during the repricing, I would say in the case of, say, Bitcoin or gold. But those will, at the end, after we exit the worst of the chaos, you might see different prices after that.
And this is about the idea that if you need market action and market prices and market orders at the market, if there's no buyers for a seller and there's no seller for a buyer, specialists are allowed to cook the books a little bit, a wiggle room, to keep markets open. But what's happened is that little wiggle room with the use of derivatives over the past 30 years has become the defining characteristic of these markets. They're completely fraudulent. So you lose, as you point out, you lose the idea of a price signal. All of these markets, when you add it together, the bond market, the stock market, the currency market, they're all flashing contradictory signals because they're all existing in what we call sometimes the Bermuda Triangle of markets, where none of the gauges if you're an economist or you're running a pension fund or you're running a retirement account, all of your gauges telling you where you are in the economy and these markets is just dials spinning wildly in opposite directions because the central banks have allowed the fraudsters to take over, essentially, and now we're having a catastrophic collapse, as we predicted, and nobody knows what to do, or nobody is willing to take the steps required to rectify the situation in a meaningful way.
Japan was the one that led us into this, remember, and the yen is, again, really important to the global financial system in terms of that carry trade and the funding currency for a lot of the speculative activity that goes on globally. So here's an interesting thing that happened as well in the past week. Japan's MMT experiment just failed today. Japan has been buying unlimited amounts of government bonds to keep yields below 0.25%, 25 basis points on their 10-year government bond. Yields smashed through the 25 basis points and have soared to 45 basis points in the past 2 hours alone. What comes next? This YCC yield curve control program has caused the Japanese yen to lose 25% of its value against the US dollar in the last 3 months alone. And so you could see from that chart, it goes back to 1986, right after the Plaza Accords of 1985. Remember when Reagan and the G5 met to basically they decided that the US dollar was too strong. Again, they might decide that right today because the US dollar is soaring, and that's part of the reason why the global financial system is falling apart.
And it's always been the linchpin to the whole global Ponzi schemonomics because it was always the funding currency. It was always the cheapest place to borrow money. You could borrow money for a quarter of a point or less, and you could go invest it through the carry trade into a higher yielding currency and then leverage that trade almost infinitely through infinite rehypothecation and just print money all day long. And because Japan at one point had a huge savings in their pension accounts, they were able to make this trade possible. But they burnt through their savings, and now suddenly the game is over. So I would say the most significant news of the week would be what's happening in Japan.
Yes, the government buying the debt there, and of course they hold a large quantity of U.S. Treasuries, and the U.S. Treasuries, they're losing money on that as well as the bond market sells off and interest rates rise. But finally, all of this goes back to what happened on February 26th, 2022. That is the most important day of 2022 so far. And that is when energy got canceled, and that is when the U.S. froze reserves of Russia, $630 billion worth of reserves. The dollar ceased to exist as basically the world we know it. Like, it's no longer the dollar that it was before because it's no longer fungible. As Arthur Hayes says, you cannot remove the world's largest energy producer and the collateral these commodity resources represent from the financial system without serious, unimagined, and unintended consequences. He wrote that before the unintended consequences started getting very rapid and very extreme. Things are about to get real.
Right. When those assets were seized, essentially, it was the end of the financialized period of economics in the globe for decades and the beginning of a new era. And that era is going to be driven by price discovery by commodity producers. And, you might not like the politics of the commodity producers, but you're going to buy gasoline at whatever price is at the pump. You don't have a choice. It's inelastic pricing. And even the UK this week said, we're going to walk away from our ESG goals, our environmental goals in the energy markets, and we're going to start buying gas.
Right. But the most important thing, Max, the single most important thing from this to consider is that Arthur Hayes says rational countries with a capital account surplus must now save in another currency. That means gold, that means Bitcoin, because they cannot save their trillions of dollars of surplus in a currency that could be seized and reserves that could be seized. Any rational actor will, over the next few months and years, we're going to see the consequences of that the seizure of reserves, of US dollar reserves on February 26, 2022. And that's why Max and Stacey Report are here.
The return of rationality.